Yes, welcome everyone. Thank you for really engaging ECG panel. And now it's last panel of the day. It's about private equity landscape, and the present funds will also share their insights on various exits they've been working in the region. So here as a moderator, we have Mr. David Matthewson. He leads the CF team in the region, which has been investing in Balkans for over 20 years. And among speakers, we have enterprise investors, Mr. Serban Roman, the country director, vice president. We have also Stepan Karpukin from Rohatyn Group, the managing director, as well as Nicoleta Banica, vice president, CEO Romania for Highlander Partners. So, David, to you.
Thank you very much. I appreciate it. Good afternoon, everyone, or good morning, wherever you're at. I'm greeting you from rainy New York City. Where we're getting the remnants of another hurricane hitting the U.S. But I hope you're well. I know it's the last panel of the day, so we'll try to make it lively and make it worth your while. Why don't we start out with just a further introduction? Let each of our panelists introduce themselves, their firm, kind of what they're working on, and so you have more context for what they're saying. So Serban, I see you're top of my screen, so why don't you go first, and we'll go around.
Thank you, David. Hello, everybody. Yes, I am Serban Roman from Enterprise Investors, Vice President and Country Director for Romania. We, as a fund, we are I would say, the oldest and the largest regional private equity fund. We typically invest from 20 to 75 million euro in a company. We started from Poland and then gradually rolled out in other countries in the region, and now we are investing from the Baltics to the Baltics to Romania and Bulgaria. Romania actually was the second country in which we invested more than 10, 15 years ago, I would say. We are generally sector agnostic, but we like consumer products and retail, business services, IT, medical services. And we did, I think, in our history of 30 years almost, we did like 150 investments and exited about 140, of which 35 or even more listed to the stock exchange in Warsaw, in Czech, in New York, or in Vilnius, depending on where the company would be present. Okay. Myself as an individual, I am chairman of a retail toy retail company in Romania, the largest toy retail called Noriel. So whenever we'll be discussing about how the portfolio company is doing, I would discuss from the perspective of this toy retailer.
Okay, great, thank you. Nicoleta, would you introduce yourself?
Hello. I am part of Highlander Partners investment team on the Romanian market. Highlander Partners is a family office headquartered in Dallas. Obviously, the vast majority of the exposures of the fund currently and historically speaking have been in the US, being very active in the middle market. Having, let's say, so the tendency to look at opportunities which will have a production angle, given also the expertise of the investment professionals which are working for Highlander. Back in 2008, Highlander decided to open its first office in the region. They started with Poland. As of 2 years ago, we are also operating in Romania. We concluded so far 2 acquisitions. We have exposures in 2 sectors, which in the current context proved to be extremely resilient. One is in the food production sector, and the other one is niche medical sector company.
Great, thank you very much. And Stepan.
Hi, thank you, David. Thank you, everyone. My name is Stepan Karpuhin. I represent TRG, the Rohatyn Group. I'm a managing director in the London office and a member of European Investment Committee. For those of you who don't know TRG, TRG, also called the Rohatyn Group, is a global emerging markets investment firm that has approximately $5 billion under management, with the vast majority of investments in the private space, private equity. We operate around the world through a network of offices, and that gives us a very strong global perspective. But at the same time, we are very local in terms of our investment strategy. We pick the best companies that we can find in each region and then work actively to internationalize, grow, and develop them across the region or globally. We have been investing in CE for a long time in Central and Eastern Europe. In total, we deployed over €1 billion over years and had a lot of successful exits, of course. And our latest investments continue. We actively look for new investments all the time. Our latest company that we bought was that took place in May this year. So lockdown is not a problem for us. We're very active and focused. Thank you.
Great, thanks for that. We're going to want to dive into that. Sorry?
Look forward to discussion.
Yeah, especially on that last point. We'll look forward to hearing how that went. But I'll introduce myself also. Again, David Mathewson. I oversee CIAF's activities in Central and Eastern Europe and also the Caucasus. The firm has been investing in the region since 1994, so it's been around for a long time through a whole series of country funds. Today, we have 8 portfolio companies still in our portfolio that we're managing in the Western Balkans. So it's exposure in Serbia, Macedonia, Kosovo, Albania, and also Turkey. So my comments today, I'll have perspectives maybe from the Western side of our region. Okay, with that, I would mention to the audience, we do want to save time for Q&A. There is a question function on this. I guess you type it out versus raising your hand. But we have 50 minutes allotted to this panel. We'll look to have at least 10 to 15 at the end to really respond to your question and hope we can have a good dialogue with you. So, I think I'd like to start out this for a question for all the panelists. It's the topic of, I guess, both this conference and really the year 2020, and that's COVID, and really how it's been impacting our portfolio companies. So I'm sure we're investing in different sectors, different industries. Love to get your perspectives on the impact, how we're coming out of it, and kind of any key successes or key ways of dealing with or some real challenges. And also maybe ask you to respond to your thoughts about 2021. I know from our perspective, we're thinking about June. In June, we were thinking of, this will be over in 2021, we'll be back to normal year. So I wonder what you're thinking about that. So why don't we begin with you, Serban, on that.
Thank you for this topic. All this COVID situation was, given how it emerged, the surprise and the effects it has, it really took us by big surprise. So if you would ask me in March how we are doing, it was at the beginning of March was so great with double-digit growth, for example, and then 10 days later, 82 stores were shut down. So lucky for us that we had the online platform prepared and highly scalable, so we were able in those strange months of April to grow 7 times year on year. So that, if you ask me about what happened, what changed, it was from a offline retailer we transformed overnight in 100% online retailer, just even without our will. But what we are doing these days now, actually, we are adapting because there is so much volatility. Again, if you would have asked me in September how we are doing was cool or reasonable, and then all growing cases in Romania and restrictions in the malls that affect the traffic are highly visible for all the retailers, I guess. So now, and especially if you look at what happened in a shopping mall versus a retail park, it's obvious that malls that were until recently the key sales generators are now lacking traffic. Retail people shifted to retail parks. So we are trying actually, even though the traffic is suffering, we are trying to convert better the traffic. So extract as much sales possible from lower traffic we have. And obviously we are looking to push online, to continue enabling, keeping the online, growing. And I think all this situation was also a good opportunity to identify other routes to grow. So I guess several companies in everywhere were thinking, okay, what we are doing now, while we have this problem, can we keep selling? Because that was I think the key for everybody. And in our case, our management did a very good job in identifying verticals in which to invest. For example, we launched in 10 days, we managed to integrate with Profi, our former portfolio company, which is a supermarket in Romania. So we integrated a toy retailer that had very strong e-commerce capabilities with a food retailer that was not e-commerce enabled. So we identified other ways to, at that point, it was other ways to sell and to be closer to the customers and to serve a need, because in May, June, there was a need to, to travel less and buy food. So I think our team did a great job on that one.
Okay, great.
For
Thanks for that.
2021, just to answer this one, really difficult to say. Again, if you would have asked me a month ago, I would say, oh, the direction seems to be good. But now if you look at the trends and the cases and everything, I'm wondering whether, at least in Romania, what will happen post-elections, because I guess there will be some restriction keep loose until the election early December, and then probably we'll go more restrictive, as you saw recently in Germany and France. So difficult to say, but I think it will be tough, as bankers and everybody is saying.
Okay. Nicoletta, move on to you. What are your views? How have your portfolio companies dealt with COVID, and what are your views for next year?
Okay, part of the elements that Sherban already mentioned were applicable in our case as well. I think because at the HashPay we have actually a very hands-on approach in general. Many of the professionals hired by Highlander Partners are actually having very strong operating backgrounds, being themselves former CEOs or CFOs or commercial managers. Basically, the start of the pandemic put us in the context where we started to be more actively involved with the managerial teams of both companies. Maybe as a parenthesis, the food platform was just acquired 1 month prior to the start of the COVID crisis over here in Romania. So it was a very interesting situation. So we started communicating quite in a very agile manner with our managerial teams, with the stakeholders of the companies. We were constantly in touch with them, trying to basically validate some of the day-to-day solutions, because that was the kind of context we were all going through, starting from preserving the cash in the companies, deciding what kind of new ways to maintain accessibility to our products, to our services for the clients were required, going down to the path where basically new CapEx had to be put at work. So maybe just to summarize, I think this first wave of the crisis taught us in a way what are the missing elements that need to be accelerated and to be incorporated actually in the strategy of these companies to remain solid on the long run. Going forward, because obviously we are I would say in a more sheltered position as a financial investor, having exposure in some strategic companies for this market, for Romania. I'm referring in here. I think we will continue to be brave and continue to invest in developing both companies in 2021 and beyond. And we are actually seeing quite a few opportunities in that respect. Some of them being already assessed at this moment.
Okay, thank you, Stefan. What are your views on these topics? I think you're fine.
Sorry, I was on mute. Still getting used to technology. Anyway, thank you. Nicoletta, you mentioned that you invested just before the outbreak of the COVID. We actually invested, as I said, in May during the COVID, and we still did it because the company was good. I frequently hear from some of my colleagues in the industry, about difficult times. I actually don't tend to think about difficult times. In reality, they're just different, accelerating, changing times. I have been in private equity industry for over 15 years and in business for much longer. Something always changes. I mean, if we are adaptable, focused, roll up the sleeves and work, everything can be solved. It's just a question of picking the company that is on the trend rather than goes contrary to the trend. And then that's all you need, and restructure in case trends change. In our portfolio, I have to say that our businesses have done remarkably well this year so far, and I'm extremely happy, and I'm very thankful to our management teams that worked extremely hard around the region to deliver these results. Out of our companies, a few are growing spectacularly well this year, a couple that are resilient, and only one problematic company in the transportation industry, but even there we're managing. But all of this, of course, took extreme amount of work. Everything is changing, and management teams invested a lot in adapting, in changing the supply channels. Similar to what Sherban said, in one of our companies that is dealing with retail, it's a pet retail platform across the region. Indeed, in some of our units, online sales grew by 800%. Suddenly with very little notice, and the management had to adapt to that and build up the infrastructure that is required and prepare and secure the supply. So immense amount of work. So far, I think the results are positive. Going to the next year, I think not much will change fundamentally. The virus will be a little bit more contained, I think. But at the same time, I think it is clear that the levels of government support that we are observing today are not sustainable, and it will be reduced with, of course, the consequences on the consumption. The only important observation I have based on what we have observed so far in our portfolio is that dedicated and responsible managers really work hard to adapt to this new environment, and we need to make sure that they do not burn out, because this is going to be continued for quite some time longer, I think.
It's interesting. That's a very good point. I think we all say we're all tired, but certainly our managers are tired too, yes. And that burnout is an issue. So let me continue with the thought on thinking about next year. We're in the midst of, we're coming into business planning season for all of our portfolio companies and putting together business plans for the coming year and investment plans. Given the uncertainty, Sherban, you were talking about, how are we going about, I'm curious how you're going about putting together your business plans. How do you determine, we've got some companies we want to live within cash flow for the coming year. So we're thinking about investments in a new distribution center or a smaller acquisition. But the environment is uncertain. So curious if you've got, how you're thinking about those issues, and if you're putting in any kind of triggers that, milestones, if this happens, you would change your business plans for next year. Anyone want to respond to that?
I can jump just with a quick touching quickly on this point. It's, there are the thinking should be a bit separated. There are some, let's say, value creation initiatives or points which you know you have to do in order to be successful. For example, in the case of Noriel, and probably in the case of any retailer, whatever it's linked to omni-channel and a smooth transition from a channel to another, that can be endless aisles, pick and collect, loyalty systems adapted to various channels. This you cannot afford to wait and see what will happen. So you have to execute. Maybe you will temporize a bit if the investments are big, but you have to do them. You ask about investment in the logistics center. That one I am not sure. I think I'm not sure I would be ready now to invest, to have a large investment project for a retailer, because there is too little visibility. And it's the same even with the expansion. So of course there can be a mall where you always wanted to be, and you know that's a great position, great location, so there is an opportunity, you will go, you take it. But I think, at least in our case, we just discussed in the morning in the board about opening location, and we don't have full visibility how will be our Christmas and our Black Friday. So we start planning, but we are doing short-term cash planning now because it's irrelevant to think long-term. And based on this, we are taking decision, unless there is a strategic decision which we know it's part of what we have to do in order to ensure a good exit.
Okay. Let me ask, kind of following on that, I'm curious your views. What is the prevailing mood within your teams in terms of taking advantage of the environment going into 2021? Are you cautious and want to just kind of preserve your position, or do you think this is a time to be more aggressive, pursue consolidations? What is the prevailing mood within your teams? But Stefan, why don't you start that?
Yeah, maybe first, just briefly to comment on your previous question. Cost efficiency, competitiveness, streamlining your business, optimizing. This must be permanent features of every business. This never stops, and especially now in these days. So that focus only accelerates now more than ever. However, while you can lose big time by having too much fat in your business, for example, or over-investing in something, you cannot win big by simply focusing on efficiency and costs. We always have a growth agenda in mind for our businesses, always, irrespective of the situation, if it changes or not. We have to find avenues, the new trends, restructure if we have to, and find a way to develop and to deliver growth. That's always on our agenda. And in this sense, not much actually has changed. Online retail is shifting, increasingly from offline to online. Okay, that's an opportunity. We have to invest in that, and we are investing in that. And that, refers to consumer businesses. There are some changing consumer behavior trends. Also, we have to adapt to that, look into the future, and invest in that type of growth. So as long as there is an ambitious business plan that is in line with the trends, we are completely up for it. So in terms of business planning, for most of our portfolio companies, next year is a growth year. There is no question. Just like this year was a growth year, next year has to be a growth year. And we're focusing on that. And the same relates to TRG, broadly speaking. We are actively investing, looking for opportunities. There always are opportunities.
Okay. Nicoletta, what are views within your team?
I just wanted to say as a joke that in times like that, only the brave people would be the ones winning. So we have to induce this kind of attitude within the management teams at the level of our portfolio companies. And I think we are quite fortunate to have the right people basically dedicated and willing as well to do the extra effort, because unfortunately it requires an extra effort from all of us to carry on with the businesses and with the stress and the level of uncertainty that we see around us. And unfortunately, I personally think it will continue like that for the next at least 10 to 12 months, even if a solution would be found for the virus. Next year, we are also having quite ambitious plans. First of all, we are continuing to invest in our teams. We are hiring people with new skills, people who would also bring this, let's say so, e-commerce capabilities within our portfolio companies on one hand, and we are very much pushing the add-on strategy in both our companies, because we see tremendous opportunities around us. And I also think that somehow we have the duty, and because we have also the capabilities, the financial means, but also the human resources means, we have the duty to shape in a way what will be, let's say so, the structure of the industry in which we are playing at the moment, because it's true that the consumers are changing, are having different expectations, but at the end of the day, if we want to be the number one, number two, or number three player in that particular industry, we will have also the capacity to shape the industry, and we are, I believe, undertaking some of the measures in that respect at this particular moment. Maybe just to illustrate it, in our food production company, we are making the first steps to implement the business-to-business platform, just to ensure that basically no matter how strict the lockdown measures would be going forward, would still be in the position to deliver our products to our partners.
Yeah, I mean, to be honest, sorry, just to add, to be honest, we in private equity are in a very lucky, luxurious position that we have access to long-term capital that we can deploy. We can ride out storms, and in this sense, we definitely, everybody needs to look around, pursue add-on strategies if you have a winning company, and we're definitely always looking, just like Nicoletta said, for new add-on companies to all of our platforms.
Let me ask you both then, are these add-ons, are they now distressed add-ons? You're able to do this because of the environment, these opportunities are distressed, or not necessarily? What are you seeing?
Definitely not for TRG. I mean, it's a nice to have if you can buy something inexpensively, but that's not the core of our strategy. Core of our strategy is to achieve synergies, buy some capabilities that are complementary to what you have already, international access, etc. Growth development. That's the focus.
Nicoletta, are you same thing? So these are not distressed opportunities. Okay.
No, same here. We need to make sure that basically we are buying viable businesses, viable portfolios that are complementary to our current portfolio. But at the same time, we have to admit that the underlying economic trends might actually impact positively the valuations in our favor. So.
Let me ask, maybe turning to exits. We had coming into this year, we had a couple of pretty good years overall in the region. I'm sure you had companies that you were working with, and maybe probably could have thought 2020 was a year of exit. I don't know if you have, but maybe you could talk about that. But what are your thoughts going into next year, the current environment? Would you see the environment being strong enough to achieve some exits? If so, any particular methods or means that you'd be looking to do that? So, I don't know, Sherban, do you have any thoughts on that question?
This year we had some exits, not many. We had at the beginning of the year a construction material business, actually a prefabricated buildings business in Poland, an extremely successful exit for us, which was closed in March, middle of March, I think. And at the end of the year, in the second part of the year, we exited some green energy projects, which are more resilient actually. So you can, more predictable, it's easier to sell. Difficult to say whether next year it's an exit year. I don't think so. I think we have one of our, let's say, key competencies is to pick the right timing for exit. And it's a bit early now to say whether next year would be right timing. It doesn't look like this. But if it would be, of course, we would accelerate and plan for that. I think we have the luxury that we are fully aligned and we have time. So we are aligned with our investors, we are aligned with our founders and with the managers in our companies. And focus of each of us is to maximize actually the exit value. So because this is our ultimate goal. And if we have to wait for this, we would wait. We wait in Profi case, for example. We received an offer at some point in time for plus minus 300 million. At that point, managers recommended that if the recommendation of managers was, let's stay 2 more years because we believe the next 2 years from the growth perspective would be perfect. And of course, we listened to them and we almost doubled the value of the proceeds. So we would always doing like this. And in our construction material business, for example, in Macon, in the last crisis, so of course it was not the best timing to exit in that period. So we were waiting until the market was proper for exit. So I think we would be adapting. If I look at our portfolio, I don't see necessarily an immediate exit in the next period. But we are always, there for the great offers.
Mm-hmm. Nicoletta or Stepan, any kind of thoughts as you think of your portfolio, kind of near-term exits or not because of the environment? And if not, are your investors supportive of continued holding, maybe longer than otherwise anticipated because of the environment?
Maybe, Stefan, if you allow me, I'll be very short because we have only 2 portfolio companies at the moment, and these are not very mature exposures for us. So we are definitely not in such a position, not even in an opportunistic manner. So we don't dare to think about such an exit. What I'm not discarding in total is maybe the opportunity to do some partial exit, in the sense, what I'm defining as partial exit, in the sense of maybe trying to seek some different commercial alliances with other players, some other type of partnerships, which will actually allow us to grow the business in a more accelerated manner and maybe across the region. That's the only scenario in which I can associate to a certain extent to the idea of an exit. And overall, because you asked about the holding period, Highlander Partners being a family office, we don't have a very strict mandate in that respect. If we look historically, the average holding period at Highlander level is actually surpassing 6 years. So,
yes, generally, I would like to say that the global financial environment and more broadly business environment is characterized by excessive supply of money. There is a lot of money to be invested in, and everybody has excess capital. Everybody's trying to deploy it right now. So I'm not aware of anyone who has stopped investing. The public markets are at peaks. So that has not changed, I think, this year, and will probably not change. Government support will continue, money infusion will continue. So I think in terms of exit opportunities, things will be unchanged. What I see different taking place right now is that there are a lot more bottom fishers, of course, and we get approached by, for some of our portfolio companies intermittently, which of course you have to resist. And also the buyers, the serious buyers, are more selective and more cognizant of the new trends and changes, and want to see that the company is adapting. But then a healthy company that's on trend will be in demand. There is no question about it, I think, and will command good valuation. So everybody is looking. LPs, I think, are very agreeable. As previous crisis, financial crisis has demonstrated, very agreeable to continue holding the companies for longer if necessary. And I think this will happen again this year if required. Everybody will agree to that if more time is necessary. And the only other thing to mention is that the exit generally in our industry is driven by the stage of development of your portfolio company. When you have contributed to the company pretty much everything that you can, it's time for the next buyer to take over. And that value creation cycle is largely what should be driving the exit decision. And so if you can continue building the value, okay, then probably it's the right time to hold on to this investment.
Okay, thank you. I just want to note we have got a little more than 10 minutes on our scheduled time. I don't see any questions yet from the audience, if I'm looking at the right place here on the screen. But I welcome. We stand ready to answer every question. All knowledge is here, so feel free to ask us some questions. But in the interim, let me ask you all. We're all focused in investing in Southeast Europe. I want to pick up on a comment you made, Stefan, that there's plenty of money. There's lots of money in the world, and our organizations are investing. We've got colleagues in Asia, right, in Latin America, and all over the world. And we see the interest and the capital that goes to some of those areas. I'm curious on what you see as the compelling reasons that we say to investors to put some of your capital in Southeast Europe. What's the pitch you make, and why? So, I don't know who would like to address that. Who's got the sales pitch?
Okay, I'm not much of a salesman, but I think the fundamentals favor this region. There is no question that this region has a high potential. And the recent history of the last decade or so of consistent growth across the whole region has confirmed that potential. The labor cost and quality relationship is extremely favorable. The closeness of the supply chain to Western Europe is extremely favorable. Convergence of consumption habits will continue. Industry integration will continue. And by now, the main problem with funding for investments in Southeastern Europe is that people simply are unaware of the developments kind of in that particular small part of the world. Global investors are not aware, and this is our job to educate them more. But some of the misconceptions include that, okay, this is the part of the world with weaker governance, but etc. But that's not true. Many of the countries actually have developed tremendously in recent couple of decades, institutionalized with good governments, good rule of law, judiciary. The banking systems are reasonably solid. There are actually banking systems in our countries, in the region, etc. So in this sense, as more and more people become aware and look for opportunities across the globe, more attention will be attracted to this particular region. I'm convinced of that.
Let's hope so. Sherban, Nicoletta, any additional thoughts there?
I'm subscribing in full to everything that Stefan mentioned. I personally believe in two theses that are quite prominent for this region. On one hand, obviously, geopolitically, but also economically speaking, this region is indeed or has the potential to become even more appropriate source of supply for Western Europe. So I think this and this should basically attract the interest of the investors. And secondly, this is my personal view. I think the people in this region are in general very early adapters of any new technology, any new product. So I think this should be also a sign of encouragement to look more attentively at the region.
Mm-hmm. Great, thanks. I would also add, I think it's underappreciated the fact that the region as an emerging market area has less currency risk than other regions. Again, I know we're all equity investors, and so equities, it's not like your loans are depreciating, but for investing in India or Brazil or other places, Turkey, that have had significant ongoing depreciations, when you're making an investment in Southeast Europe, you're either, several of the countries I'm investing in use the euro, and the other countries are linked to the euro. So you don't have the same currency risk, which has been so detrimental to returns over the last 20 years for investors. I think that's a story that's underappreciated by investors.
And all this theory about reshifting supply chains, which actually also Stefan and Nicoletta mentioned, is just shifting to proximity. So our region is there to be the provider for the Western Europe. So this plus convergence of consumption towards Western Europe plus sizable size of the population. So it's a big region. So all this should be the enablers of continued above the average growth. So it's a cool place to be.
Yes, and David, you correctly mentioned currency risk exposure is significantly less and manageable. However, I would even broaden this argument. Generally, there is a perception in the investment industry, higher risk, higher return, requires higher return. But in reality, this is not a high risk geography. In substance, in many ways, this is actually a lower risk geography compared to many of the so-called developed markets, with more upside opportunity, with lower downside, because many of the industries are in their nascency and the only way is up. And because actually political risk in many cases is lower than what we're seeing in developed markets, in developed world, societal risks, etc. Governments, many of them are less over-leveraged than some of the developed markets, etc. So I think there are a lot of misconceptions, and they will eventually, I mean, my thesis is that substance always prevails in the long term. I think in substance, this is an extremely attractive market, and it will become more and more visible over time.
Right. Let's hope. I agree with that too, and it'll take more demonstration of successes. Good returns generated, good exits made that show that this region you can be quite successful, and that should attract the capital. Okay, we now have a flood of questions. I don't think we're going to get to them all because we want to stay on time. I know. One writer asked a simple question: what do we see as interesting sectors for roll-ups and consolidations in our region? Where's the easy money to be made? There's no easy money. There is
no easy money.
Any particular sectors? And would we see? Do you see any prospect of doing a kind of a blank check company in our region? Have you heard any rumors about that?
It's okay. The blank check company, generally, I think this is a promising concept, and there are more and more private equity firms, traditional private equity firms, that adopt this strategy. And I mean, this is, I think, a limited, short-term, super mandated, and narrow investment thesis is an artificial construct, and broader approaches will develop over time. We're seeing the trend. I have been talking about this for a while. I think it's a clear trend. From the viewpoint of specific investment opportunities for roll-ups, we at TRG try to pursue roll-up opportunities as a matter of our strategy. We do individual investments, but platform investments occupy a large part of our portfolio and our attention. We're doing this in retail, in healthcare. For example, the company that we acquired this year was in clinical research business, and we are now, touch wood, closing on a couple of add-on acquisitions imminently, and that will continue. In many of the service industries, there is a long tail to be consolidated with significant scale benefits and technology as well in many sectors, actually.
Okay. Thanks. Here's a question, kind of a good technical question, but given COVID and the unexpected changes that can come, literally week to week within COVID, would you see, lockbox mechanisms for closing transactions kind of fade away in favor of closing accounts, just to take advantage? Yeah. Any views on that?
I apologize, David. I guess my internet broke up for a second. I didn't catch the question.
Because of COVID and the short-term changes that can happen, sudden changes, would there be maybe a move to a preference for closing accounts as a basis for closing transactions versus a lockbox?
That's possible yes, for businesses that are undergoing significant change, or where significant change might be foreseeable.
Lack of predictability. Yeah.
Completely correct. We have historically used both mechanisms for completions, and we're comfortable with both. But I think you're right. This is actually a valid observation. There will be a trend towards broader usage of closing accounts. Yes.
Interesting. Sherban, you had a comment?
My comment was exactly the same, that it depends on the company and the predictability you can have on the number. So if it's something which is pretty highly predictable, then you can opt for both. But if you want more predictability, then you would probably go for closing accounts.
Here's somewhat of a related question. Due to COVID-19, it's probably harder and harder to come up with you said here a 3-year business plan that you can really underwrite. So how do we get comfortable valuing businesses and making investment decisions with a business plan that's subject to significant variation?
In 2 lives ago, I worked in a consulting firm with a gentleman who invented the concept of supply chain management. And he always taught us that the only thing you can with certainty say about a forecast is that it's going to be wrong. So you cannot base your investment strategy on some kind of forecast. They always end up to be not perfectly correct. But you do have to have a directional perspective of where a particular business is going. And barring certain completely transformative events, there will be variations a little bit to the left, to the right, but directionally, you have to be pretty certain about the development, because making short-term investments that with very short payback times is not going to work universally. So in order to achieve some transformative investments, you have to have a longer-term perspective. Sometimes you would be wrong, but most of the time you'll be right.
The idea is, even if you are wrong, but you catch correctly the direction, then you will not land on a moon, but you will land on a star nearby. But still, you know that you will be there, somewhere up there. If you just go against the trends, then you will, have more chances to fail. And then the trick is, of course, that you are better off paying a bit more for a company that you feel that is going in the direction that it's obvious, than paying a bit less for a company that is going in a wrong direction, and you hoping that you will shift the course to a different direction. So in the first case, you will maybe make a bit lower returns. In the other case, you have good chances to just lose your investment.
Yeah, I would add also on this, I agree with all those, that typically, we are all longer-term investors. We've mentioned that earlier. We underwrite 5-year business plans, not 3. We have that kind of vision. And the assumption is you're going to go through a business cycle in 5 years. So you're going to have something, and so COVID is one of those business cycles that you work through. But over the course on a 5-year vision, as you all have said, you're moving to the company to a different level. So hopefully a star. Well, we've reached our time. I know there are a few other questions. Maybe our panelists, you can, I would invite you all, audience, to reach out to any of us directly. We're with known firms. I'm sure you can find our email addresses, and we'd be delighted to follow up with you and tell you more what we're doing in the region, and look forward to maybe we'll do a deal together. So with that,
idea.
That's right. Bring us a deal. We're happy to do that. So with that, I would say thank you to my panelists. Thank you for participating and for your ideas. Thank you for all the audience. We can't see you, but thank you for participating. And I guess we will turn it back to the sponsor.
Thank you.
Thank you, David.
Thank you.